Welcome back. Today on the Byte-Size Brief, we are going deep on Nebius Group, trading under the ticker NBIS. I'm going to guide you through a one-on-one financial explainer on what has literally become the most fascinating, fiercely debated, and explosive infrastructure stock of the entire year. If you've been watching the markets over the last 3 months, you've definitely seen this ticker commanding headlines. But today, we're cutting through all that noise. We're going to deliver a calm, entirely objective deep dive into the numbers, the underlying business model, and the very real risks at play here.
Here's our roadmap for today's explainer. We'll start with an introduction to Nebius, break down their AI cloud business model, and then review their recent changes and massive contracts. After that, we'll weigh the bull case directly against the bear case, and finally, look at their future roadmap.
Section 1. Introduction to Nebius Group, the breakout AI cloud stock of 2026.
To really grasp what's happening with this company, we have to look at the absolutely unprecedented demand for compute capacity right now. Nebius is aiming to become a primary provider here, targeting an astonishing 16 data centers with 3 gigawatts of contracted energy capacity by the end of 2026. And it's that sheer, massive scale that drove a 574% 12-month stock gain leading into May 2026. Just recently in April, we saw the stock violently surge from the low 100s straight up into the 160s. Why? Well, it's driven by a massive structural undersupply in the AI compute market. Training and inference demand is literally outpacing GPU availability, power, and physical data center space. Nebius sits right at that exact bottleneck, promising to deliver exactly what the market is so desperate for.
Moving to Section 2, the AI cloud business model, demystifying the strategy.
So how does Nebius actually make money? Right off the bat, they aren't just a basic GPU rental service buying NVIDIA chips and leasing them out. To understand their real competitive moat, you have to look at the AI startup lifecycle. In Phase 1, which is prototyping, startups usually rely on closed-source models like GPT-4 or Claude. It's easy, it helps them find product-market fit fast, and crucially, it requires zero technical infrastructure overhead. But Phase 2 is where the economics completely break down. Once a company scales and hits high user volume, staying on those closed models causes their inference costs to absolutely explode. They literally must switch to open-source models, like Llama, to make their unit economics work. And this is exactly where Nebius steps in. Moving to an optimized open-source infrastructure can drop a company's inference costs by 10 to 100 times. That is a game changer.
Which brings us to their core product, the Token Factory. Don't think of this as just a warehouse full of chips. Think of it as an AI refinery. It's a managed inference platform that lets companies run and fine-tune these open-source models incredibly efficiently. We're talking routing, caching, auto-scaling, and full enterprise governance. By acting as this refinery, they completely separate themselves from raw metal providers. What they offer is post-training as a service. It's highly sticky, and it integrates them deeply into the daily operations of their customers.
Section 3. Recent changes and contracts. The Meta mega deal and Wall Street's reaction.
If their tech stack is the foundation, recent enterprise validation is what just poured gasoline all over the stock price. Nebius has secured a massive, mind-boggling $46 billion total contract stack. This includes a $19.4 billion multi-year supply agreement with Microsoft, and, maybe even more crucially, a recent $27 billion AI infrastructure deal with Meta. This Meta deal is absolutely paramount. Meta has essentially committed to purchasing whatever remaining AI compute capacity Nebius doesn't sell to other customers. It acts as a guaranteed backstop, a massive revenue floor that hugely de-risks Nebius' highly aggressive, multi-billion-dollar capital expenditure roadmap.
And Wall Street? Well, they took immediate notice. Goldman Sachs just made one of its boldest calls of the entire year, bumping its price target on Nebius by a full $45, going from $155 up to $205 a share. They also raised the revenue estimates for fiscal years 2027 through 2030 by 30 to 54%. But take a really close look at their 2026 CapEx projections. They kept their 2026 revenue estimates totally unchanged, but highlighted a massive $16 to $20 billion expected capital expenditure. This is a very deliberate signal from Goldman. They are acknowledging that Nebius is in a heavy investment mode. The long-term durability looks to be there, but the short-term cash burn is going to be monumental.
Section 4. The bull case for NBIS. Extreme growth and hidden assets.
Okay, so what is the concrete argument for buying the stock at these elevated levels?
a lot of analysts are pointing to a sum-of-the-parts valuation thesis. See, the market right now is valuing Nebius almost entirely on its AI cloud execution risk, basically ignoring billions in other hidden assets. For instance, Nebius owns Averide, a self-driving and delivery robot company that's partnered with Uber and Grubhub. That alone could be valued at $2 to $3 billion. They also own Triple10, a fast-growing edtech platform worth maybe $300 to $500 million, and they hold really significant stakes in the data annotation firm Toloka and the database giant ClickHouse. When you actually add all of this up, you have roughly $5 billion in hard, tangible business value totally outside of their core cloud infrastructure.
Furthermore, you can't deny that the core business is absolutely executing right now. Their Q3 revenue surged an incredible 355% year-over-year. And honestly, more importantly, their AI operations are already EBITDA positive, with margins sitting right around 20%. Plus, remember that terrifying $20 billion CapEx build-out we just talked about? Well, to fund it, they're sitting on a massive, multi-billion-dollar liquidity cushion. They've got over $5 billion consisting of cash, short-term investments, and working capital with basically zero long-term debt, so they absolutely have the war chest required to fight this battle.
Section 5. The bear case and risks. Extreme valuation and execution peril.
Now, we absolutely must pivot to the brutal financial realities balancing out all this hype. Because in the markets, no massive growth story exists without a shadow. The crucial point here is this staggering figure, 22,995. That is the price-to-sales ratio of Nebius Group. That's based on a $35 billion enterprise value against their last reported annualized Q4 2025 revenue, which was roughly $117.5 million. I mean, this is among the most extreme valuations you will find anywhere in the public markets. At this multiple, the stock is quite literally pricing in absolute, near-perfect execution of their target to hit $7 to $9 billion in annual recurring revenue by the end of 2026. Make no mistake, any misstep or any delay whatsoever will be punished severely by the market.
Which brings us to the central, existential, competitive question here: can they survive the hyperscaler bloodbath? They are stepping into a $260 billion war zone against Amazon AWS, Microsoft Azure, and Google Cloud. These are trillion-dollar behemoths. They have infinite cash, absolute economies of scale, and deeply entrenched enterprise lock-in. If AWS or Azure simply decide to drop their prices just to starve out the smaller competitors, Nebius's margins could literally evaporate overnight.
As one analyst so starkly put it, capital intensity, this industry will eat them alive. If Nebius mismanages scaling, pricing, or infrastructure, they're dead. Scaling 16 data centers with 3 gigawatts of capacity in just one single year is a logistical nightmare. It requires flawless execution across the board. Site acquisition, securing the actual power infrastructure, navigating dense European regulations, and hiring highly specialized talent. Let's be clear, execution risk is the single largest threat to this stock today.
Section 6. Future Roadmap and Conclusion. The Path to May 2026.
So if you're tracking this company, the narrative and the hype, they don't matter anymore. We are officially entering the prove-it phase. Here are the immediate catalysts you need to watch. First up, in Q2, we need to see the successful integration of their recent $615 million acquisition of Eigen AI. This is meant to really strengthen that token factory inference platform we discussed. But the most critical date on the entire calendar is May 13th, 2026. This is their Q1 earnings release. Management has been pretty quiet recently, and this call is going to be the absolute inflection point for their credibility. They must provide concrete updates on their capital deployment, show us some customer diversification beyond just Meta, and prove whether they are truly on track for that $7 to $9 billion revenue run rate and those 16 data centers by the end of the year.
So, we are left with the ultimate question. Will Nebius's execution actually match their breathtaking valuation hype, or will the trillion-dollar hyperscalers crush this AI cloud underdog? Look, they've got the engineering talent, they definitely have the Meta backstop, and they have the cash to burn. But the margin for error right now is absolutely zero. That wraps up today's deep dive explainer on Nebius Group. For a sharper, more candid discussion on these exact numbers, be sure to join us on the full audio explainer. Drop your questions and your own takes down in the comments. We read every single one. See you next time.